Ladies and gentlemen, good day and welcome to DOMS Industries Limited Q3 FY24 Earnings Conference Call hosted by ICICI Securities. Before we begin, a brief disclaimer. The presentation and results release which DOMS Industries Limited has uploaded on the stock exchange and their website, including the discussions during this call, may contain certain forward-looking statements concerning company's business prospects and financial performance and profitability, which are subject to several risks and uncertainties, and the actual results could materially differ from those in such forward-looking statements. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Aniruddha Joshi from ICICI Securities. Thank you, and over to you, sir.
Yeah, thanks, Lizan. On behalf of ICICI Securities, we welcome you all to Q3 FY24 and 9 months FY24 results conference call of DOMS Industries Limited. We have with us senior management represented by Mr. Santosh Rasiklal Raveshia, Managing Director, and Mr. Rahul Shah, Chief Financial Officer. Now I hand over the call to the management for their initial comments on the 9 months and quarterly performance, and then we will open the floor for question and answer session. Thanks, and over to you, sir.
Thank you, Aniruddha ji. Hope I'm audible.
Yes, sir. Please go ahead.
Thank you. Good evening, everyone. It is our pleasure to welcome all the participants to our first earnings conference call for the quarter 3 and 9 months period for the financial year 24. Joining me on this call is Rahul Shah, our CFO, and Marathon Capital, our investor relation advisor. I hope everyone had an opportunity to go through our investor deck and results release that we have uploaded on the exchange and our company's website. To begin with, I take this opportunity to thank all of you and the entire capital market fraternity, with a special mention to our shareholders for the overwhelming faith shown in our initial public offering. The listing marked a significant milestone in our journey, motivating us in achieving excellence ahead. Considering this is our first call post-listing, for the benefits of participants whom we are interacting for the first time, let me spend some time to provide an overview of the company. DOMS is one of the India's leading stationery and art product company. Our journey started in 1973 with the formation of RR Industries by our founders, my father, late Sri Rasikbhai Raveshia, and my uncle, late Sri Mansuklal Rajani, who over the years undertook the business of manufacturing and sale of pencils and crayons. Subsequently, in 2005, we launched the DOMS brand by incorporating this company, which was known as Right Fine Products Private Limited. In 2011, with an objective to streamline our operations and achieve integration, we merged all stationery business of group into this company. Further, in 2012, we entered into strategic partnership with Fila, a listed Italian multinational company engaged in supply of various art materials and stationery products with a global presence. As a company, we have focused on growing substantially and remain steadfast in our mission to consistently increase our market share in the interesting Indian market. Today, the company manufactures and sells well-designed quality stationery and art products, categorized primarily into 7 categories that includes scholastic stationery, scholastic art material, paper stationery, kits and combos, office supplies, hobby and craft, and fine art products. The company's products are primarily sold under the flagship brand DOMS, as well as through our other brands like C3, Amaris, and Fixifix. Our manufacturing facilities are located in Umargaon, Gujarat, and Baribrahmana, Jammu. Our operations are spread over approximately 36 acres of land with over 1.25 million square feet. We are focused on achieving a greater degree of backward integration, which we believe enables us to improve efficiencies, ensure quality control, reduce dependency on third parties, and enhance profitability. At DOMS, we continue to focus on expanding our manufacturing capabilities so that we can quickly and effectively cater to the increased market demand of our products. Our ongoing expansion at our existing facility, coupled with our proposed 44-acre expansion, will provide us required resources to continue our growth momentum and enhance our market share. The success of our company would not have been possible without our multi-distribution channel network, which is spread domestically across 28 states and union territories of India, as well as in our 44 countries globally. The company's keen focus on research and development, product engineering, backward integrated-led manufacturing operations, driving a large and diverse product offering has enabled DOMS to become the fastest growing stationery and art material product company in India in terms of revenue over the past few years. We believe that India continues to have a strong demand for stationery and art material segment, and DOMS is well positioned to capitalize on this growth opportunity, reinforcing a long-term vision of pursuing robust and profitable sales growth. We are sincerely thankful to our consumers, our channel partners, and our passionate team, which has helped us in delivering consistent growth. With this, I would like to hand over the call to our Chief Financial Officer, Mr. Rahul Shah, for the update on Q3 and 9 months financial year 2024 financials. Thank you very much.
Thank you, Santosh Bhai. Good evening, everyone. Coming to the details of our financial performance highlights for the quarter ended December 31st, 2023 and 9-month period ending the same. I would like to state our revenue from operations for Q3 FY24 grew by 22.3% year-on-year to about 3,716 million, and by 29.5% year-on-year 9 month ended 31st December to 11,334 million. This growth was backed by increase in capacities across our core product categories, as well as introduction of new product segments like writing instruments, as well as increase in the average selling prices of our products. The EBITDA for Q3 24 grew by 42.7% year-on-year to 694 million, and EBITDA margin expanded by 270 basis points year-on-year to an impressive 18.7%. EBITDA for 9 months ended December 31st, 23 grew by an impressive 57.8% year-on-year to 1,968 million, and EBITDA margin stood at 17.4%. This strong growth in EBITDA margin was primarily on account of lower raw material prices, as well as owing to the change in product mix and the benefit that the company received with the consolidation of Microwood, our subsidiary company. Profit after tax for Q3 FY24 grew by an impressive 43.4% year-on-year to 388 million rupees, and PAT margin stood at 10.4% as compared to 8.9% in Q3 FY23. PAT for 9 month FY24 grew by 69.1% year-on-year to 1,127 million Indian rupees, and PAT margin for this period increased to 9.9% as compared to 7.6% in 9 month FY23. The consistent growth in our performance reflects the power of our brand acceptance and is testimony of our effective implementation of our business strategy. On the operational front, we continue to focus on expanding our manufacturing capabilities to capitalize on the growth potential and gain market share. Towards this aim, we have spent approximately 280 million Indian rupees in capex in the third quarter of FY24, and have recently added about 100,000 square feet of manufacturing floor space in commercial production during this quarter. The manufacturing operations at this new plant was commercialized in a record period of 90 days from the completion of construction. Another 100,000 square feet of plant is under construction, which is likely to be operational during first quarter of FY25. This, coupled with our proposed 44 acres expansion, will provide us with the required resources to continue our growth momentum and enhance our market share. With this, I would request Anirudh to open the floor for question and answers. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kunal Vora from BNP Paribas. Please go ahead.
Yeah, thanks. Congrats, Santosh bhai and Rahul bhai, for the listing and strong results. A few questions from my side. First is on the margins. EBITDA margins fairly strong at 17.4%, like more than 300 bips improvement. And if I go and look at the 4Q last year, like again margins were strong. It implies that you might end the year with more than 17.5% margins. So I wanted to understand how sustainable is this, and are there any adjustments which we need to be aware of?
So, Kunal bhai, like mentioned during the call, the increase in margins are attributable to three key factors. One is a slight reduction in raw material prices, which was about 1.5%. There was a positive impact on account of integration of, consolidation of microboard, which is about 0.6%. And the rest change is due to the change in the product mix. There are certain products that we manufacture. We have a very vast portfolio. Certain products which are high on material consumption but low on direct expenses, and vice versa for some categories. So because of change in this product mix, we saw an improvement in the gross margins. At the same time, there was a slight increase in cost of manpower and power and fuel and such other expenses, which offset the gains in the operating margins. So as a result of this, we achieved this EBITDA number of 17 odd percent. Going forward, from a sustainable number, we continue to have a targeted EBITDA range for this year and between 16 to 17%. And going forward for the next year, between that sustainable number would be about 15 to 17%.
But this year, like when you already had 17.4,
yeah,
and 4Q at least like looks like last year was strong. In that case, why are you guiding to a lower number, 16, 17?
Certain raw material prices, which were lower in the previous quarter have, again started to increase. The last quarter, certain polypropylene prices were, probably very low. This year, starting this year, we started seeing a reversal in that.
Understood. Thanks. Second one is on capex. So, like, what number will you end up with in FY24? And like, if you can talk about plans for FY25, 26, and what will be the focus area of investments?
So in the first 9 months of the year, our capex has been about 117 crore rupees. In the last quarter itself, we did about 28 crores of capex. In the current quarter, we project that the capex would be upwards of 30 crores. We've started utilizing in this quarter some proceeds from the IPO for the proposed project. So given that, we will do end up this year close to about 150 crores of capex. Going forward in FY25, FY26, our capex would be between 200 to 225 crores in each of the 2 years.
Okay. Lastly, if you can talk about while all the divisions seem to have done well, paper stationery seems a little weak. Is it because of decline in paper prices, or if you can talk about like why that segment seems to be weak?
So Kunal bhai, in paper stationery, if you see in the previous years, the contribution of export sales to the overall paper business was higher. In the current year, due to some challenges in key markets like Europe, etc., exports have been a little lower, and that has impacted the paper business. But that has partially been offset by the increase in demand in the domestic market.
Understood. Okay. I have more questions, but I'll come back in the queue. Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and want to ask a question. The next question is from the line of Ankit Kedia from PhillipCapital. Please go ahead.
So just wanted to understand what is the volume and value growth, for first 9 months and the quarter, and along with that, specifically in the pencils business, if you can highlight what has been the volume and value growth.
So, Ankit bhai, at a company level, it is really very difficult for us to talk about volume growth, because we manufacture a lot of different products and each are sold in different sizes, units, packs. But if you talk specifically about wooden pencils, which is a key product segment for us, compared to the quarter ended in December 22 to quarter ended December 23, the increase in volume was about 16% in terms of volume. Then there are certain products, other key products like watercolor pens, mathematical boxes, where we've increased capacity there. Volume increased by about 61% and about 72%. So there have been significant volume growths where the company has added capacities. And on terms of value growth across most of our product segments, we've seen ASPs increasing in the range of 3 to 5%.
And specifically for wooden pencils, what has been the ASP increase for the quarter and 9 months?
Pencil, if we talk about our, again, we have two components there. One is wooden black lead pencils and wooden color lead pencils. Black lead is the significant portion, where the ASP increase has been about 3.5%.
So is it safe to assume that the wooden pencils is growing slower than the company average?
No, not really. Like I said, not really. If you look at the overall company level, our growth in scholastic stationery has been close to similar what has been our overall growth. Plus, also there's an interesting thing. For example, a lot of you'll see a significant growth in kits and combination packs. Again, these packs, pencil is a large constituent there. So those increase in capacities get diverted towards sales of such packs also.
Sure. And sir, could you just throw some light on, the channel-wise growth, what you have seen in the quarter? How has been the distribution expansion and, for 9 months and for the quarter, and where are you seeing higher growth?
So, like we've always maintained, our priority market has been the domestic market, and in domestic market also we've always focused on the general trade segment. So, general trade, segment continues to have the focus for us. This segment constitutes more than 75% of our total sales. Otherwise, from a channel perspective, channel mix, it has been pretty much in line.
So last year, FY23, general trade was 74%, and for the 9 months you are saying it's grown to 75% plus.
75%, yes.
So the decline is coming in which channel?
So if you see our numbers and the presentation, we highlighted that exports has been, which was earlier about 21%. Export has now slowed down due to certain, markets where, demand has been lower, like Europe, and plus certain disruptions due to this logistical challenges from Red Sea disruption. So because of which exports have been smaller and now constitute about 18% of our sales. So that has been, absorbed by the domestic market and primarily in the general trade.
Sure, that's helpful. I'll come back in the queue for more questions. Thank you.
Thank you. The next question is on the line of Amit Jeswani from Stallion Asset. Please go ahead.
Hi, Ravesha ji. First time we are speaking. Good evening. My first question, sir, is that how large is the opportunity in front of us? And where do you see DOMS being in the next 3 to 5 years? First of all, congratulations on being a billion-dollar company by market cap. But what kind of profit pools do you aspire to generate for the next 3 to 5 years? Would you be continuing to growing at, so last decade we've grown at about 27%. Would it be right to say that kind of growth rate is sustainable for the next 3 to 5 years?
So, Rahul here. So, just to take your question on the growth and the guidance, for this year, FY24, we'll end with a growth rate of between 25 to 26%, and this is a similar sort of a growth we will target to achieve in the coming financial year as well. In terms of opportunity, we really believe that the opportunity in the Indian stationery and art material segment is significant. Not only is the market increasing because of certain factors like focus on government initiatives on education and all, but also there's a lot of new demand coming in. With respect to whenever we've launched certain types of new products which were not existent in the market, but the acceptance level of these products has also been very great. So we believe we'll be able to expand the market as well. So with new product developments, with our focus on R&D, product engineering, and getting the best product available at the best value, we think that the market potential is significant, and with our expertise and experience, we'll be at the forefront to leverage this benefit in the coming years.
And would you say that you would be reinvesting 100% of your operating cash flows in setting up more capacity every year?
Very difficult to answer this at this point of time, but yes, we continue to see good opportunity in the existing product segments. There are a lot of new product lines that we would enter. In addition to organic growth, we are always on a lookout for attractive inorganic opportunities. So how things shape up, that will really constitute that whether we'll be doing 100% reinvestment. But yes, we do believe that the potential is huge, and we would want to be at the forefront with getting maximum market share as much as possible.
So on our highest category, which is pencils, we are about 11% of the entire market, right?
No, entire market of sorry.
Pencils. What would be our market share? Sorry.
Market share would be about 11 to 12% of the entire stationery market. Pencil is within that segment. If you talk about, then we are at about 29%.
Got it. And the industry, stationery industry, is growing at about 8%. Would that be the right benchmark? And we would be able to grow at 3 times faster than the industry?
So overall industry is growing at about 11 to 12%. Then there are certain categories within the industry which are demonstrating a little higher growth as well. For example, pencils, writing instruments, which are close to about 16% growth.
Got it. So got it. And our gross margins will stay at these levels broadly for going forward in the newer categories that we enter?
So, if you look at, gross margins across different products are different, and therefore we, as a company, always look at EBITDA as the right, value to justify whether these products are doing well or no. So, on an EBITDA perspective, EBITDA level, any new product that we intend to introduce, we work with that targeted EBITDA margin of 15%, and only then, proceed in terms of introducing that product in market.
Got it. Thank you so much. I'll come back in the queue.
Thank you. Reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Mehul Desai from JM Financial. Please go ahead.
Thank you, team, for taking my question, and congratulations for the great set of numbers. So my first question is on the distribution side. If you can give some flavor as to how has distribution increased versus what you ended on FY23, and how do you look at it going forward over next 2 to 3 years in terms of your outlet reach? That's the first question. Second question is on the regional mix. If you can give some flavor, how much of your revenues are coming from North and West market, and how much is coming from South and East, and what is the strategy to drive growth more in South? My understanding is that we are under-leveraged or under-indexed in South versus our North and West markets. So if you could address these two questions.
Yes, Mehul, sure. So Mehul bhai, to answer your first question, in terms of retail footprint, in Q2 we had about 1,20,000 retail outlets which were touching directly, which was serviced through our sales team. In the third quarter, this number increased by about 2,500 retail touch points. In terms of distribution reach, the increase was close to about 200 distributors during the quarter. In terms of regional mix, if you see historically also we were present in accord, sales from each region justified the population of that region, and even currently it is similarly justifying the presence where the population is highest. North, it constitutes to the highest sales, followed by West, and then South and East. So it's a very balanced mix in proportion to the population of that particular region.
Sure. And any guidance on where this distribution can go over next 2 to 3 years in terms of the outlet reach which you mentioned?
So it will be a gradual increase. Our strategy from earlier time has been that wherever we reach, the new retail outlet we open, we maximize the throughput from that particular retail outlet, and therefore, wherever we are entering a shop, we would want to justify the requirements of that particular retail outlet and only then expand. So it will be a gradual increase over a period of time, and we would not want to get into that numbers of increasing it at a very fast pace, but do justification to each store where we are present.
Okay. And any flavor that you would like to give on what kind of newer categories that you are looking? I think we have taken a small stake in a toy company too. So if you could mention what's the outlook in these categories, what are the plans, or what are the new categories that we like where we think that we can expand maybe in next 2 to 3 years apart from the current stationery products that we have?
So, like you were aware, in this current financial year, we entered the conventional pen segment. That as a product segment is something which is seeing a very good and positive response from the market. After the launch of this product, since about 7-8 months, we have been able to, meet the requirements only of few states in India. We've not been able to sell this at a pan-India level as well. So this product segment is seeing a lot of demand and, interest from our consumers. Similarly, scholastic adhesives, we are in the process of launching a very wide range of scholastic adhesives and also expanding our product portfolio in the fine art range. So these are the key product segments or categories where there would be, continued focus. Nevertheless, in our existing product segments, categories also, we continue to keep coming out with new SKUs which are more relevant with what our consumers are experiencing, and those product launches keep happening on a regular basis.
Sure. Great. Thank you. That's all from me.
Thanks, Mehul.
Thank you. The next question is from the line of Chinmay Neema from Present Capital. Please go ahead.
Good evening, sir. Thank you for taking my question. Just trying to understand the historical performance of the company. So if I look at the last 2-3 years, the top line has almost doubled from FY22 to FY23. So could you help us understand what happened during